last year was the most volatile year in terms of a lot of contexts. You know, sporting clubs won that weren't supposed to win. The markets were all over the place. There was Trump. What are your thoughts looking back at 2016?
As you mentioned, Murray, 2016 was a year of significant uncertainty. The markets suffered their worst start to the year since the Great Depression, and negative headlines really flooded the markets. The US markets were down 11% in the first 6 weeks. China's markets were put into a trading halt just to stop the bleeding. Oil prices collapsed, and there was genuine fear that China could have a hard landing. And then the Chinese authorities unleashed a massive stimulus plan which saw markets recover into mid-year. But from there we saw a lot of unprecedented events, really commencing with the Brexit vote in June. And then we had a prolonged US election campaign which was fought between two of the most hated candidates in history, and as we know, Trump was the eventual winner there. And then we had a failed Italian referendum, and the Federal Reserve in the US finally raised interest rates. But despite all of those events, the markets were surprisingly resilient, with many markets either at or near record highs into year end. That said, most or nearly all of the gains made during the year were done in the 7 weeks after Trump's election win.
Yeah, Chris, I was in London when Brexit broke, and breakfast television was basically going to go to the public and say that we're in. And that morning, they were in complete disarray. So you couldn't really appreciate the shock that it had in the UK. When you were there, it was just amazing stuff. What do you see as the outlook for 2017?
Well, as we head into 2017, I think we can see more of the same uncertainties that was there in 2016. The geopolitical calendar is very busy this year, particularly in Europe. We've got expensive valuations, and Donald Trump is running the White House. And it's difficult to understand what a Trump presidency means for markets, but so far the markets have been very excited and sentiment is very strong. So now we need to see whether Trump can actually implement and deliver on his promises to keep that momentum moving as we go forward. So looking ahead, we've got expensive valuations. So there's a lot of questions to ask and answer as we head into 2017, some of which include, does inflation take hold? And will the US Federal Reserve have to raise interest rates quicker than anticipated? Have we seen the end to the 30-year bull market in bonds? And does the rotation out of bonds and into equities continue? And if that is the case, given current expensive valuations, can equities continue to push higher? And at this stage, it's really too early to answer any of those questions. But what we can expect in 2017 is that it's likely to be a very volatile year.
Yeah, I think generally people are misunderstanding the market doesn't appreciate the risk in the bond markets. If there's any sort of inflation in the US and we get a rise in interest rates, a very small rise in interest rates reduces the capital value of those bonds significantly, so that it's disproportionate because of the way the bond markets are set at the moment. So these perceived safe assets can be extremely risky. In the late 70s, when the bond market crashed, I was at university, and it was pretty horrific, and people really didn't expect it. So, given that safe investments can be extremely risky, what would your message be to investors?
In an environment such as we're in now, where all asset classes are expensive, whether that be cash where you get no return, bonds just because we've got near record low interest rates, or equities and property that have high historical valuations, investors need to review their return expectations and also their time horizon. A long-term investment strategy requires patience. So short-term thinking can cause investors to behave and act irrationally. So really what we're saying to investors is that patience will be rewarded over the long term. And it's very rare that you achieve your desired outcomes if you are going to buy expensive assets. And buying high typically or historically means lower expected returns in the future. So we're prepared to be patient and wait for those buying opportunities to arise in order to achieve our longer term objectives. And we always ask the question before we'll allocate capital: am I being adequately rewarded to take risk in this investment right now? And if the answer is no, then we're prepared to be patient and wait for those opportunities to arise.
Yeah, bubbles don't adjust, bubbles burst. One of the things that I was talking to some clients the other day, if you've got $1 million and you invested in a bank account, a safe investment, $25,000 return. So people are chasing this yield and they're not really factoring in the amount of risk they're taking by chasing that yield. I think patience and astuteness are two words that come to mind, which will be the key to investing in 2017. What should investors expect?
Well, given current high valuations, history suggests that future long-term returns are going to be lower. So investors need to lower those return expectations, particularly if they're just going to buy and hold the market, whether that be cash, bonds, shares or equities, because they're all expensive. So if we're holding that broader market, we're buying an expensive portfolio. So to avoid that lower return expectation, what we're suggesting investors look to do is focus more on the total return as opposed to capital or just income. It's the total return over the period. And as we mentioned earlier, buying high assets means that you've got to wait for those assets to move even higher, which is a big ask in the current environment. It will take a long period of time. Whereas being patient and tactically allocating capital to where the opportunities and the value lies will go a long way to ensuring that investors have a better chance of achieving their return objectives over that medium to long term.
Given the volatility in markets, we're still pretty confident that our market neutral philosophy is the way forward.
The current environment is very challenging. Investors can either chase high risk for potential high returns, but that also comes with potential large capital drawdown should markets roll over. Or you can focus more on risk-adjusted returns and that absolute return focus, which isn't so much reliant on markets to do all of the heavy lifting. There's a lot more tactical skill involved in selecting which markets to be in and which asset classes to be in. We believe that that's the best option for investors to achieve those expected returns. And at this stage, we maintain a very high conviction that our investment strategies can achieve our longer-term return expectations, even in a lower returning environment. It just does require patience to look through that shorter-term noise and focus on the longer-term outcomes where we can be rewarded for taking on risk.
Yeah, and I think the other thing is that you've really got to avoid the herd mentality. You know, being patient. There's been a bit of a run in markets driven by Trump. To join that group in a bubble environment is probably doing exactly the wrong thing at exactly the wrong time.
That's exactly right. The herd mentality and the overcrowded asset classes and trades typically set investors up to fail. If you're going to take that approach, you really need to have a handle on when you're going to exit, because you don't want to be the last one. So really it's more about finding unique opportunities where you are being rewarded to take risk and you're not following that herd. Because there's opportunities out there, but as we've said, it just takes a bit of patience to find them, and typically it's at the expense of the greed that has fueled markets, and when that greed turns to fear, that's when the buying opportunities present. and that's where investors make most of their long-term wealth. And those opportunities arise quite often, and patients will seek them out.
Yeah, they're the keys, isn't it? Patience and astuteness. Chris, thanks very much for that.
Thanks, Mark.